Hey, this is Yossi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss what I view as the 3 best REITs to buy following the recent market crash. I've been personally buying more shares of these 3 REITs over the past few weeks, and I'm going to share all of it with you completely for free in this video. The only thing that I ask in exchange will be that you click the like button, subscribe to the channel if you enjoy the content. Thanks so much in advance. Okay, so the market's been crashing over the past few weeks. Tech stocks are down about 20%. The S&P 500 is down about 15%. REITs have fared quite a bit better so far. They are down only about 5%. So they've been significantly outperforming the rest of the market in 2025. And I think that this is because REITs are not really heavily impacted by tariffs. They generate most of their revenue domestically by renting their real estate. And they're not heavily impacted by a recession either, because most REITs earn their rental revenue from very long leases. In many cases, their lease is over 10 years long. And so their rental income doesn't change materially whether we're in a recession or not. I'll put a chart on the screen that will show you a comparison of returns between the S&P 500 and REITs during past recessions. And you'll see there that REITs typically do much better in late cycles, and they also suffer less downside during those recessions. And so I think that this explains why REITs have been outperforming so far this year. I would actually take this a step further and argue that REITs could actually benefit from today's tariffs. And that's because, for one, it will make the cost of construction far higher. And if the construction cost is higher, we will likely see less development activity, less new supply coming to the market, which will then lead to faster rent growth for most REITs going forward. It also increases the replacement cost of existing properties. So that's all positive. Secondly, it also increases the risk of a recession in the near term, and as a result of this, the debt market is now expecting significant rate cuts later this year. It's currently pricing 3 to 4 cuts in 2025, which is quite significant. It would lower interest rates from the low 4s into the low 3s. I think that this will be a very positive catalyst for the REIT sector, given that they today trade at decade-low valuations because of the recent surge in interest rates. So therefore, I'm really not panicking following the recent market crash. On the contrary, I've been taking advantage of this volatility to buy more shares of some of my favorite REITs, and now I'm gonna get to 3 of them. The first one that I want to discuss is not called NewLake Capital Partners, ticker symbol NLCP. This is one of just a few REITs that specialize in cannabis cultivation facilities, and I think that this is one of those property sectors that won't be impacted by tariffs because the cannabis is produced domestically. These properties are all in the US, so there's very little international exposure. Also won't be impacted by recessions because typically people actually smoke more, also drink more alcohol during recessions as they look for a way to reduce their stress, their anxiety. And so it's a recession-proof sector for the most part. On top of that, NewLake Capital Partners is a triple net lease landlord. Its leases are very long with 14 years left on them on average. Its tenants are responsible for all property expenses. The leases include preset rent escalations of nearly 3% per year. And so again, whether we go into a recession or not shouldn't really impact its cash flow. The tariff shouldn't have any impact either. But despite that, its share price has been dropping with the rest of the market because, as capital pulls out, everything drops, and this is what has happened here. And so I think that NewLake Capital Partners is a very interesting opportunity now. It trades at just 7 times FFO. It's offering a 12% dividend yield. I just recently got to talk to the CEO of the company. We posted an exclusive interview at High Yield Landlord, and one of the interesting takeaways is that I asked him about the dividend, and he said that their current dividend is at the low end of their target range of 80 to 90%, and this seemed to imply to me that they are likely to hike the dividend again in the near term. And that's quite exceptional for a company with such a high yield. Typically, when you're getting an over 10% dividend yield, that's because the company is facing severe headwinds and is at high risk of cutting the dividend. Well, in the case of NewLake Capital Partners, it seems to be the opposite. They think that the dividend is sustainable and likely to keep growing going forward. And as a reminder, this REIT has actually hiked its dividend in most quarters since going public. So I think that this is not just talk from the CEO who's trying to, sell his REITs. I think that he's very serious about this. Another very interesting aspect about NewLake Capital Partners that I like in today's environment is that it's net cash positive, meaning that has more cash than leverage, practically has no debt on its balance sheet, and so it's not affected at all by the interest rate volatility. It makes it a lot more resilient. It also it gives it optionality to acquire more properties at a positive spread over its cost of capital, which would accelerate its growth going forward. You add to that the 3% annual escalation in its leases, and I think that there is a realistic path towards 5 to 8% annual FFO per share growth, again, which is truly exceptional for REIT trading at such a low valuation and high dividend yield. So this is definitely one of my favorite REITs to buy in today's environment. I bought more shares recently. If you want to read our full interview with the CEO, you can access it with our 2-week free trial. It will be the first link in the description of this video. Okay, the second REIT that I've been buying is called Alexandria Real Estate, ticker symbol ARE. It's a REIT that I've covered quite a bit on this channel. I unfortunately started buying it a bit too early at higher levels. It has seen its share price drop since then. I've kept accumulating more of it at every drop, so much so that it's slowly becoming one of my largest REIT holdings today, and that's because I'm very confident in its long-term outlook, and I think it's deeply undervalued at the current levels. Okay, so this is what you would typically classify as a blue chip REIT, and that's because it owns Class A properties that have historically enjoyed some of the best growth prospects in the entire REIT sector. These are life science properties that has historically over the past 10 years on average enjoyed 6% annual same property NOI growth. This is truly exceptional for any property type, and it demonstrates that these are Class A properties that enjoy significant barriers to entry in their local market, enjoy rapid demand growth, and so very attractive assets to own for the long run. Blue chip management as well. They have an amazing track record, having managed to outperform the broader stock market by a significant margin. They've outperformed even some of the most rewarding stocks over the long run, such as Warren Buffett's Berkshire Hathaway. And then blue chip balance sheet, very low leverage, BBB plus investment grade rating. I think they have the most liquidity of any S&P 500 REIT. Very long debt maturities at 13 years in average. These are some of the longest debt maturities of any REIT that I know. And so it's not heavily impacted by the surge in interest rates either. I think it's not heavily impacted by the tariffs. In fact, the pharmaceutical products have so far been exempt from the tariffs. It has long leases as well, so it's not heavily impacted by a potential recession. Its average remaining lease term is 8 years. Its leases include 3% annual rent escalations in most cases. And besides, this is a healthcare property sector. Its demand is not really a function of the economy. It's more a function of demographics and the aging population, which leads to more demand for pharmaceuticals and more, which pushes then more money into research and development of new drugs. Yet, despite that, its share price has crashed. It's dropped about 65% from its peak. Again, as I said earlier, I bought it too early. I cannot time the bottom. I don't know if this is the bottom either, but in any case, it's down very significantly. It's down 65% since the end of 2021. And the interesting thing is that during the same 3-year time period, it has actually grown its cash flow by another 20%. So you add the 65% drop with the 20% surge in its cash flow, and it's essentially now priced at just about 1/5 of what it traded at just 3 years ago. I agree that it should have dropped somewhat because it was likely a bit overpriced in the end of 2021, and the fundamentals of its properties have suffered a bit now due to oversupply and will likely suffer a bit further now for another year or two. So it's fair for its valuation to drop, but I think that pricing it at just 1/5 of what it traded at in 2021 is not rational either. I think that the market has overreacted to near-term headwinds caused by oversupply, not understanding that this will be temporary. Real estate is cyclical. It goes through cycles of oversupply, commonly followed then by undersupply as developers eventually get hurt, scale back their construction projects. And this is what's happening right now. We had a huge wave of new supply following the pandemic because this led to a significant boom in new research and development of new drugs. We had a lot of new supply coming to the market, and so now we oversupplied, but now the new construction activity has already dropped very significantly, and so I think that we'll see much less supply hit the market in 2025, 2026, 2027, and with that we'll eventually see the demand catch up to the supply, especially because I think that this is one of the few property sectors that will significantly benefit from AI, and that's something that the market has so far overlooked in my opinion. And why do I think that life science properties will benefit from AI, and that's simply because it will make the research far more efficient. And if research is more efficient and faster, more productive, it will lead to much more experiments. And so the labs remain very much needed, but I think that these properties will become a lot more productive, increasing the value to its user and allowing Alexandria to increase its rent and increase the value of the property. I also think that will bring a lot of new players into the biotech space. Suddenly now already we're seeing big tech companies, traditional tech companies like Amazon and Nvidia slowly move into biotech, and we also have a lot of AI-driven biotech startups now coming to this space. And all these companies, all this new competition will want labs, because again, just because you're able to do research more efficiently with AI doesn't replace the need for labs to conduct these experiments. On the contrary, it increases the need for labs. And so if now we have more companies competing for this high quality space, and this space is more productive for them, I think that will increase rent growth over the long run and increase the value of these properties. Yet this is a narrative that's so far completely overlooked by the market, and so I think that there's a very attractive opportunity here to buy shares of Alexandria while they are discounted because of short-term headwinds, while the market is still overlooking these long-term tailwinds. Right now it's trading at a 10-year low valuation, about 9 times FFO. It's offering a 6.8% dividend yield. That's the highest yield I've ever seen Alexandria trade at. The dividend is very well covered and has been growing. I expect it to keep growing. The management is buying back shares. That's the story in a nutshell. So again, I cannot time the bottom. I've been buying too early, unfortunately. But I think over the long run, it won't really matter, and it will still be a very successful investment. And I keep accumulating more shares of it at today's pricing. Before going to the third REIT, again, can you please do me a huge favor by clicking the like button? Helps me a lot to keep producing all this free content for you, especially as I'm traveling. Thank you so much in advance. Let me just 1 second check my notes to see what was the third REIT I want to discuss. Okay, so it is a company called Vesta REIT, ticker symbol VTMX. This is one of the leading industrial REITs in Mexico, and this may not strike you as an obvious pick because we're in the middle of a trade war. Mexico has been hit with quite significant tariffs at 25% at the moment. So how would a Mexican industrial REIT benefit from this? Many of you may even think the contrary, that it will going to suffer a lot, and perhaps that's why its share price has been dropping so much. But I actually think that Mexico will benefit from this over the long run, because these REITs have been profiting in recent years due to the growing trend of nearshoring. And I think that this trade war is actually going to accelerate this trend of nearshoring, because China is the one that's really heavily targeted now in this trade war. They've been hit with, at first, I think it was around 50%, I think, was it 64%? Then it was increased to 100, then to 125, 145, and now I think that the highest tariff rates on certain Chinese goods is at 245%. So, and China has retaliated, and so there's a proper trade war with China. And so I think that this is going to accelerate the trend of companies moving portion of their supply chains from China to Mexico to be closer to their end customer. And again, if you're comparing the tariff rate on Mexico of 25% compared to that of 245% on China, it makes Mexico way more attractive than it even used to be compared to China. And that's really what matters, because even with a 25% tariff on Mexico, producing in Mexico is still way cheaper than producing within the United States in most cases. And I think it's also going to cause a growing divide between countries like China, Russia, dictatorships, versus Western countries like the United States, but also Canada, Europe, which I hope one conclusion of this trade war is that the West will get closer together. This may be wishful thinking, but that's what I'm hoping. And so with that in mind, I think that more companies also from Canada and perhaps Europe will also move more and more of their supply chains to countries like Mexico instead of China. And so I think that the demand for high quality industrial space in Mexico is not going away. On the contrary, I think it's going to accelerate as a result of this. And so a REIT like Vesta should benefit from it. Yet its share price has dropped significantly following the news of tariffs put on Mexico, since most people didn't think it that far, in my opinion. It's now trading at a historically low valuation of just 12 times FFO. Its dividend yield is low at 3%, but keep in mind that this is only because the REIT retains most of its cash flow to reinvest in growth. The REIT has a significant land bank and very large development pipeline ahead of it, and so it's rightfully retaining most of its capital, since it's able to invest it in these highly rewarding development projects with initial expected yields of about 10%. which is way more than what it would get for stabilized properties like these, which are typically at closer to 6%. So it's creating significant value for its shareholders. Its leverage level is also historically low at just about 20-25%. And so it has significant financial capacity now to reinvest in these new development projects, which will significantly expand its cash flow in the future. The REIT has issued a midterm guidance to grow its FFO per share by 10% annually through 2030. And that's a really rapid growth rate for REIT trading at just 12 times FFO. And so this is one of the reasons why I built a very large position in Vesta. I also like the diversification aspect of investing in Central and Latin America to not be too heavily exposed to just one country like the United States. And so that's one other reason why I'm heavily investing in Vesta REIT. Okay, so these were three of my favorite purchases in today's market. To recap, Vesta REIT, Alexandria Real Estate, and NewLake Capital Partners. But there are many more opportunities at the moment following this intense volatility that we're going through. And if you want to access my entire portfolio and all my trade alerts in real time, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. It will be the first link in the description of this video. As I've said before, this is a risk-free 2-week free trial, meaning that you won't be charged anything for the first 14 days. You can cancel anytime, no question asked. But if you decide to stick with us beyond the 2-week free trial, you also get a 20% discount for getting started today. Thank you very much again. Please click the like button. See you at my next one. Bye-bye.